Welcome to the What's Your Deal podcast, where we discuss business acquisitions, investments, management, and exit strategies. I'm your host, Matt Euler. Let's dive in. Welcome back to another episode of What's Your Deal. Today we're joined with August Biniaz, who's coming to us from August. I believe you're in British Columbia today. Is that right?
Well, I'm part-time. I'm part-time between Vancouver, Canada, British Columbia, and Southwest Florida, Naples. So I'm currently in our Naples offices, but back and forth. I think that's going to be part of our conversation as well between Canada and the U.S. and other items.
I love it. Well, let me take a minute and just introduce you, and then I can't wait to hear more about what you're up to. So August is the co-founder and chief investment officer of CPI Capital, where he leads investment strategy, acquisition, and asset management. With over 15 years of real estate experience, he's been involved with closing more than $225 million in multifamily and BTR assets. August is also the host of the Real Estate Investing Demystified podcast and is a recognized voice in commercial real estate. And this is super interesting to me. You also recently completed the Private Equity and Venture Capital Executive Program at Harvard Business School, which further enhances his ability to structure deals and attract institutional capital. So thank you for joining the show.
Absolute pleasure. Thanks for having me.
Yeah, it's wonderful to have you. And so one of the things that as I was looking at your background and what you do that was so intriguing is I saw some history of fixing and flipping properties and construction and all kinds of things. So maybe you can share with our audience just your background and how you ended up so deep into real estate the way you are today.
Yeah, no, of course. I'm currently in the institutional real estate private equity space, but my background is unlike lots of other people in this space where they go through, going through some of the best schools, Ivy League schools like the Harvards of the world and working for large firms and eventually branching off and starting their own private equity firm. My background was really grassroots when it comes to real estate. I come from somewhat of a real estate family. My maternal grandfather was in real estate. And so real estate was a language. I really understood it. I got into real estate early on in my early 20s as a real estate broker. Soon after that, I realized that I had more of a talent when it came to deals and, acquiring deals. This is single family fix and flips. Basically, this is over 20 years ago. And that's what I started doing fix and flips. Soon realized that a lot of your profits erodes away if you bring in on a GC to do the work for you. So I rolled up my sleeves and became the GC on a lot of that work itself. So I'm not really physically doing the work, but managing, bringing on the trades and suppliers and so on. And from there, I started my own home building company in Vancouver, the west coast of Canada. Actually, Vancouver and Toronto, the two largest cities in Canada, were both going through a real estate boom because there was this huge inflow of Chinese and other immigrant population coming into Canada that could become a citizen in such a short time. And one of the first things they would do is buy real estate in Canada. So I started building both custom and spec homes. Custom is when you build a home for a client to their specification. Spec is when you build a home yourself and you fund it and then you put it on the market, hope to make profits. So I did that for a decade. But I always wanted to scale, always wanted to do bigger projects. At some point, at that time when I was doing my own deals, I always felt limited to the amount of capital I had access to. If it's myself, maybe my immediate family or some close friends for some joint venture partners or close associates, but not this idea of raising capital from the members of the public, this concept of real estate private equity or in a smaller case like syndications or funds. But when I realized there was a mechanism to do so, that's when I really kind of went all in on real estate private equity, co-founded CPI Capital in its initial mandate was different than what it is today. But yeah, I'll stop there. See if you have some questions.
Well, that's great. And I guess part of what, with your background, it made me wonder, what was it about, what inspired you to start CPI? Why go private equity? What was that about, that transition?
No, a great question. I always looked across my space when I was a home builder and I looked at who's building these high rises. And Vancouver has had many different immigrant populations. So in the 60s and 70s and the 80s, it was the Italian Canadians that were in the construction industry. And in the early 2000s, they were the ones building these high rises and large projects, right? Real estate projects. But it was multi-generational. It had taken a few generations for them to now be building these projects. So I always felt that that was my limitation. That's going to take my kids or grandkids to eventually be able to build these larger projects. But the drive was there, the enthusiasm was there, and I always wanted to find out, how do I expedite the process? But I didn't really understand the space. I never went into any type of schooling for finance or what have you. It was really, I really learned kind of, boots on the ground in business and in real estate. So, but that was the motivation. The motivation was, how do I go from being a single family home builder to build these large projects, right? And when I realized how others were doing is through this process of raising capital or syndication. And when I realized that, that's when I kind of started educating myself in that space and so on. But then also the business plan changed. The idea was no longer building high rises because, real estate in Canada has its own difficulties and flaws and pain points because of the, not business friendliness of the different levels of government, taxation laws and rules, and Canada is more of is somewhat of a social democracy welfare state. So it's hard to be able to scale and build, unlike the U.S., where it's very much capitalist. But my business model also changed. That I started looking at U.S. deals, and I felt we had a competitive advantage, somewhat of a monopoly when you had U.S. deals that were yielding much more than deals in Canada, and bringing those deals to Canadians. And that's kind of started the mandate for CPI, was to allow Canadian investors to have exposure to U.S. commercial real estate, specifically multifamily value add.
Oh, very interesting. Okay. And so for our audience, can you kind of just describe the private equity group that you have, or how you've structured that as far as a real estate company? For example, do you find a property and then you seek the capital? Do you have capital already in place and then you're out shopping? Walk us through your process on that, please.
Yeah, absolutely. I mean, when it comes to raising capital for a real estate project or any other venture, you're overseen by the regulators, be it in Canada or the U.S. And there is a vehicle to allow investors, be it real estate investors or others, to be able to raise capital. It's usually called a fund, right? That's what is known as a real estate fund. And a fund, usually a 10-year close-end fund, its first year or two, the fund's plan is to raise capital. The next few years, the fund goes out there and it deploys capital and buys deals. And then the last few years, the fund wraps up and sells those deals and distributes the profits to its investors. Historically, that's what a fund model looks like. But as a newer firm, not having a track record and not having a large investor database and not having institutional type investors, it's difficult to go to some investors you've recently met or your friends and family or business associates and say, hey, give me some money. I have this idea. I'm going to go raise $10 million from you guys. We're going to go buy these great real estates in the U.S. and we're going to, do this great business plan and we're going to share the profits. It's a difficult, it's somewhat of a leviathan of a task to do. Whereas if you actually have a deal and you put that deal under contract and you have a very specific business plan for that deal, and the investors can feel it and touch it and know exactly what they're investing into, that's a lot easier process than a fund. So yeah, I mean, earlier on with CPI Capital, our strategy was syndication. This model is known as a syndication model. So you find a deal, put it under contract, create your offering documents through your attorneys, create your marketing material, have a webinar for your investors, present the deal, get your investors come in and participate, and then hopefully you get to close over the next 60 days after your deposit has already been provided to the seller. So we call it the shotgun approach of buying real estate.
Well, and I've been through that process a couple times myself as well. So I appreciate there's a whole lot of work that goes into it, and ideally you get to the finish line, but not always, right? Which we'll come to. And I know from our dialogue a little bit that multifamily is something you really have your sights set on right at the moment as a great opportunity. Why is that? What's the opportunity you see there?
I mean, we're talking about multifamily in the U.S., right? So if you look at a demographic that lives in multifamily, lives in apartment communities, approximately more than 10% of the U.S. population lives in apartment communities. 1/3 of the U.S. population rents or renters. And from that 1/3, from the total population, over 10%, around 45 million Americans live in apartment communities. Now, 5 to 10 million of that 40 to 45 million people, they are renters by choice. So they're either downsizing or they're living in A-class apartment communities. But approximately 35 million Americans are workforce and are living in these apartment communities throughout the U.S., right? And and U.S. is becoming more and more a renters nation, as real estate prices increase, as interest rates have increased relatively these days. It makes affordability much more difficult, right? If you compare where rates were just a few years ago to where they are today, it's much more expensive on a medium home price basis to own rather than to rent. It's cheaper to rent today. If you look at a medium home price, which is around $430,000 in the U.S., is a lot cheaper to rent than own. So it's a model, it's a demographic that is going to be there. So and no matter what happens with technology, no matter what happens with business, life, and other situations, the demand is going to be there. People always need a home to live. So, and then coming back to the economic side of it, U.S. has the highest rent to value ratios in the world as far as I've searched. So if you look at on a per door basis, let's say we buy a $10 million property, 100 units, and we bought each unit at $100,000, right? So that's a $10 million property. So the rents for that property is usually around, a monthly rent for that property is usually $1,000. So you're hitting the 1% rule for that property you purchased. Not anywhere else in the world you look at, if it's Canada, if it's Western Europe, if it's Middle East, other places, that rent to value ratio is much lower. Like for example, in Canada, you're looking at 0.3% of 1% is what type of yield you're getting, what type of rent you're getting. So because of that cash flow, because of the yield it produces, it becomes a very safe asset to invest in. That's why you have a lot of worldwide institutional investors. If it's sovereign wealth fund, if it's the Canadian pension fund, and so on and so forth, they all invest in U.S. commercial real estate because it's such a safe asset. So that's kind of my thesis and what I've researched over the years when it comes to multifamily. On the ground itself, on the asset level itself, if you compare multifamily to single family, multifamily has economy of scale. So if you buy a 100-unit apartment community, a bunch of your tenants, 5 of your tenants move out, you're still sitting at 95% occupancy. Whereas if you buy a single family or a duplex and one of your tenants move out, you're sitting at 100% vacancy, 50% vacancy. So the economies of scale is there. It's a lot cheaper to get a property manager to rent it. If you got a short-term rental or single family or a duplex or quadplex, the property management costs are like 10% of your gross rents. On multifamily is 3%, right? So the economies of scale are there. But the type of debt that's offered, you want to be positive leverage, and it has performed tremendously well over the last 20, 30 years. Multifamily has.
That's great. And as CPI Capital, are you focused on properties that need quite a bit of work? Or are you focused on properties that are literally just humming along and you take over and either hire a manager or manage in-house? What's your portfolio desire?
Yeah, no, that's again a great point. So our strategy is multifamily value add, and what that means is that the property is in need of some upgrades. If it's exterior upgrades, interior upgrades, if it's the tenant profile, if it's efficiency in management, or having realizing other types of incomes that the property currently is not charging. Our strategy is buying somewhat older apartment communities and force appreciating it through our renovation process and what have you. Now, is multifamily, a core strategy or core plus strategy where the property is either brand new or very new? Is that still their strategy? It is, but not for investment firms like us. That's more for REITs, more for public REITs, because the yield they're looking for, the type of yield they're looking for their investors is much less than a group like us, right? So we're looking for approximately 15 to 20% average annualized returns when you combine the cash flow the property produces and the upside at divestment, totaling around 15 to 20%, whereas public REITs, they're looking for less yield, right? And in some cases, they're putting higher down payments. They don't need to force appreciate it. As long as they're buying a property at a 4 cap, they're happy with that because their plan is more long-term and a different strategy than ours. So it does work in both ways. It depends on the investor profile and the investment firm's strategy.
Well, and with your background in construction, it sounds like that makes a lot of sense for you. And I like the term forced appreciation. It's like, so you're going in with upside because you know what you can do with the property, and then of course increase rents and then return more value. So that's great. Is your role within your company? I mean, are you boots on the ground overseeing these projects when they're in that remodel phase, or you've got a team that's handling that for you, or how do you facilitate that as an organization?
Yeah, absolutely. I'm the chief investment officer, so I oversee acquisitions and asset management. So on the asset management division, our VP of asset management oversees the construction crews and everything related to milestones, timelines, hiring the contracts, and what have you. So as far as me physically being there, that's not the case. I do site visits, at time to time. But with so many softwares and tools these days, everything is very much transparent and instant kind of updates on what's happening with the project and so on.
Yeah. Well, in your introduction, we had the reference to BTR, so build to rent. And that's fascinating to me because most of my background is in business acquisitions and real estate, investment real estate. But the build to rent piece would rely on your skill set to manage that process. I mean, that would be a much longer term project to get to return on investment, I'm assuming. And but clearly that's an area that you have an expertise in as well.
Yeah, no, absolutely. But, I have to kind of, for sure, kind of dissect this a bit more. When it comes to, like, our focus is being an investment firm and asset managing our multifamily value add projects. When it comes to our BTR projects, even though I've had extensive background in construction and development, be it single family or multifamily, and my partner, Paul Hopkins, our VP of investments, has, he's a civil engineer, long history of involvement in real estate and building bridges across Canada and the US, multi-billion-dollar projects. We don't want to pretend that we are home builders because it's very regional. You have to know the trades and suppliers in that region. You have to understand the code and so many other things that go with construction and the crews that you need to have and what have you. So we have, anytime we do a build to rent project, we partner with a local developer in the region, in the city we want to be in. So I hear sometimes some groups start, oh, hey, we're going to start developing deals. Is not as easy as it seems. Same thing on buying a business, as you discussed. If you want to buy a business, I'm sure the person who is sponsoring an acquisition of a business is not going to go there and get involved in the day-to-day operations or think they're going to do it better than whoever has done it for years or decades. So yeah, we leave that up to the professionals on that level. But then on our asset management side, when we're overseeing the developer that we've hired or partnered with, we have the tools and mechanisms to make sure that they're hitting the right milestone, they're within budget. We've over the last 20 years, there's been cases that personally or through groups I've been involved with, or my partners have been involved with, there's been situation of trouble or distress. So we know what things could possibly go wrong, making sure we put the right debt on it, make sure we have enough reserves. So I just wanted to make sure that I distinguish those aspects of bringing a professional to conduct their work and overseeing that professional having the background to do so. Yeah,
absolutely. And so as a build to rent project, is that something where you're expecting to be fully occupied, and depending on the size, of course, I'm sure, is that a couple of years, 3 years? I mean, to go from ground up, and have a fully occupied or at least appropriately occupied building. What kind of time frame do you forecast for that?
It depends on your strategy. So historically, build to rent has been a strategy where an investment firm or a developer buys a piece of land, entitles that piece of land, builds purpose-built rental housing, be it single family, duplex, triplex, quadplex, and then after it gets it stabilized and gets it rented, so 90% plus rented, and then depending on the strategy, they either exit and sell to an institution who buys the deal for cash flow, those types of REITs that I spoke about before, or keeps it long-term for cash flow and refinances at some point. But the plan is after construction, after certificate of occupancy has been awarded, has been in hand, at that point, the stabilization process starts. So it usually takes a year to get the property from zero occupancy all the way up to 90%. Is market dependent, is cycle dependent as well. But that's usually the timeline that it takes to stabilize and occupy such a property.
Okay, well, that's great. It's actually quicker than I might have thought. So, and is there, in the properties you're focusing on, is there a certain number of units that you're looking for, unit count, something like that, size?
Yeah, particularly for us, for our strategy, our sweet spot is we're building duplexes.
Oh, okay.
So build to rent is usually single family, community purpose-built single family homes. In our case, they're duplexes because our strategy is a bit different than the strategy that I mentioned. Our strategy is actually another strategy that exists in the build to rent process is that we partner with a local developer. We bought a piece of land. We jointly entitled that piece of land. We started constructing a community of duplexes. But with our developer partner, we start pre-selling these duplexes to investor types who want to come in and buy them for cash flow. Mm-hmm. Our development partner also has a property management arm. They're vertically integrated, so they're managing these properties. So they're totally turnkey for these investors who are coming in and buying these duplexes for the cash flow. California investors and others who come into Texas, into San Antonio to buy these duplexes. So it's very much streamlined and hands-free for those investors. So it somewhat de-risks the project. So we're not, they're being pre-sold. So by the time their certificate of occupancy comes in, we get a tenant in for them and manage it for them, and then their purchase price then buys out our investors and our GP team and wraps up our syndication because now we're out of the deal because they've purchased the deal, in tranches, what have you.
Okay. And so once you find a target, what kind of time frame does it take for you to be able to complete that purchase? Let's say it's an existing property, not a build to rent. What's that time frame like? And maybe you can walk us through some of the steps. You went through it a little bit as far as getting investors, but can you guide us through that?
Yeah, it also depends on your risk profile, right? So the moment that you do not have that's why development and construction, they're very risky. That's why most banks don't even lend to, on construction deal. You usually have to go to, type of lenders or private lenders or what have you, because it is very risky because there's so many things could go wrong. You could buy a piece of land, you could go through the entitlement process, but through the county or the city, you might end up not getting as many lots as you expected, or there could be some environmental issues, or there could be drainage or other costs that were not underwritten in the pro forma. So with us, we really want when we find a project with our development partners, we really want the contract. If we're not purchasing it entitled already and shovel ready, as is known in the space, we want our contract to say that, yes, we'll go ahead and put a deposit, we'll lock this thing up, but we want to go through the process with the city or the county to get it shovel ready, and at that time we'll complete the transaction. So that's a very important step. And then from there, then you got the next steps when it comes to starting their horizontal construction, bringing all the servicing in, and eventually starting the vertical construction. But a timeline depends again on the region and the city. So for our Apollo Oaks project in the Helotes market of San Antonio, from the day we went under contract to receive all of our permits from the city, that took approximately 4 months.
Okay.
So now we've received all the permits from the city and we're ready to go horizontal, meaning that all the different crews are going to come and flatten out clear the lands, bring in the services, and in a few months we'll be ready to go vertical.
Okay. And so during that whole process, you're working either with some capital investors of some sort. So you've got, especially having been in it as long as you have, I'm sure you've got resources available, and it's just a matter of who wants in that specific project. And then do you create a single purpose entity for each project?
Yeah, exactly. So we got to quickly differentiate between the investors who are buying these duplexes for the cash flow. Those are different investors than the LP or passive investors that partner with us and fund the equity that's needed for the construction and development process. So yes, every time that we have a deal, we create a SPV, a single purpose vehicle, a U.S. limited partnership. And the reason for that is because limited partnership are more tax efficient for our Canadian investors getting involved in U.S. deals. So we create a U.S. limited partnership. Our U.S. investors invest directly into the U.S. limited partnership, which we call the U.S. Master Fund. And we also have a Canadian component. So our Canadian investors invest in our Canadian SPV, project-specific SPV, and which is called our Canadian Feeder Fund. And then the Canadian Feeder Fund invests into the U.S. Master Fund just as one investor and subscribes to the U.S. Master Fund. So we have to adhere to both U.S. securities laws and regulation and the framework, and also the Canadian securities law. So we have two offering docs and two types of regulatory bodies that we have to adhere to.
Wow. That's certainly so. Because of your relationships in Canada, that would be the reason that you would, have Canadian investors as well. But that's a substantial amount of work to cooperate with both countries.
Yeah, that's just on the compliance and on the org chart and what have you. But you also have taxation as well, because taxes are different between the two countries. And early on, when we had, initially we had 100% of our investors were Canadian investors. Today, 70% of our investors are Canadian, 30% U.S. investors. But one of the initial pain points that Canadian investors had was their need to have to file U.S. taxes and deal with the IRS. A lot of Canadian investors were already dealing with the CRA, Canada Revenue Agency, and they're like, "But I don't want to deal with the IRS as well." So that was, we got together with our tax lawyer and securities lawyers, and we came up with a structure that alleviated the Canadian investors from having to file U.S. taxes. The partnership files on taxes on their behalf, so they don't have to file U.S. taxes. The other complexity is depreciation. On a lot of these multifamily properties, there are depreciation and tax losses you could utilize against your ordinary income. Now in the U.S., especially with the new big beautiful bill, that tax write-off is close to 100%. You can get 1-to-1 on the write-off you get on investing in a multifamily because of cost segregation and so on. But in Canada, those the depreciation is not calculated at the same velocity. So the Canadian investors don't get the same benefits as U.S. investors. So there's another complex layer of figuring all of that out. And then on top of that, you got also investor psychology. So when we had the Apollo Oaks deal under contract, and when we were going through the process of raising capital, the Trump administration came out and said they're putting tariffs on Canada. So we usually keep detailed record of when we have a deal and we send that deal out, we get our investors to do something called a soft commitment, saying that yes, they're if everything looks good, they will participate in this deal, and then we track how many of those investors fully commit, and it's usually 90% of investors who soft commit and end up fully committing. But with that particular deal, approximately 70% of our investors walked away. Canadian investors, due to national pride reasons and other concerns about what could possibly be happening. So we lost out a lot of investors. Now, some of them did come back and change their mind because it was very volatile. The situation was very capricious. So, and we ended up oversubscribing because there was a lot of demand for the deal. But yeah, you deal with that aspect of it as well, which sometimes is above and beyond, regulatory items or securities related items or taxation. You got to deal with people's psychology as well.
Yeah. Well, that's my appreciation for what you do is growing, and the further we talk, trying to balance all of that. between the two countries and the dynamics between them as well is got to be a challenge. And how often do you go down the road where you're working on a project and you've got time and resources and all of that committed to it, and it doesn't come to the finish line for some reason, or is your due diligence process great enough that you don't have that happen very often? What's that like?
No, that happens. I mean, that's probably one of the better lessons I've learned in real estate is sometimes, best real estate deal you ever do is a deal you walked away from. There was a deal in Tucson, Arizona, we were purchasing 71 single family homes from a merchant builder who was building this to sell them individually. But we approached them and said, hey, we'll buy all 71 homes from you. Just build it for us. We'll do a forward purchase contract. But the Fed started increasing the Fed's funds rate. So the deal every 2 weeks or every 3 weeks, you had to re-underwrite the deal. And at some point, the deal didn't make sense no longer. Now, this was still early stages. So when it comes to sponsors or general partners, there's an opportunity cost that we pay out of our own pockets because there is no investors involved yet. We are out there sourcing deals and doing all the flight and everything else. Now, later on, you could charge some of those expenses back to the deal, but if a deal that falls through because it just wasn't making economic sense no longer, those are losses that you take as a general partner. But on the flip side, there's also great rewards when it comes to financial rewards with being a general partner. But yeah, I mean, I learned a lot of lessons from that deal that didn't work. So yeah, absolutely. There's a lot of times that deals don't work. There's on the multifamily value add side as well. We, at times, because we have this shotgun approach of having approximately 60 days to get a deal and raise all the capital and close on the deal, sometimes we were preemptively starting a lot of our marketing material and other documents. Sometimes the legal material were ready, but a deal that falls apart, those are all the losses to us as a general partnership. So yeah, that takes place all the time when deals fall apart and no longer make sense if it's something that happened on the asset level or something happened on the seller or some details within the contract or what's happening in really the macroeconomic kind of cycles with the economy, what's taking place when it comes to interest rates and everything else. So yeah, things like that happen all the time.
Yeah. Okay. So from an objective of just to give a perspective of volume, so how many projects this, let's say in 2026, do you hope to bring into CPI Capital? I mean, how many projects might you close in this coming year?
Yeah, I mean, we're hoping to at least close on one multifamily deal in 2026 and at least one BTR development deal in 2026. Mm-hmm. When it comes to we've spent a lot of time on the equity side of the business and we've created some great systems and processes when it comes to our investors, when it comes to communications and updating our investors. And the fact that we also partner with both Canadian and US investors allows the capital formation to be a lot easier for us. So our pain point currently is deal flow, not the equity. And the deals, unfortunately, are not penciling. Now, on the development side, they make a lot more sense, but the development has a bit more risk. We don't want to be over allocated on development either. But when it comes to multifamily is going through its somewhat of a bust cycle. If it's, as is known in real estate, a recession cycle, deals are not really penciling. There's a wide bid-ask spread between what the sellers want and what a firm like us can pay for deals, and a lot of deals are just not transacting either. So we're also seeing a lot of distress in the multifamily space when it comes to a lot of groups who've put deals under contract in 2021, 2022, and now the rates have increased. Their rate caps are expiring. Basically, insurance policy you put on a loan, if it goes above a certain interest rate, the rate cap kicks in, but that rate cap now expires. You have to purchase a new rate cap, which is costing much more than what the original rate cap was. You also have, because debt was so cheap in post-COVID, first year or two after COVID, a lot of developers started building. So you have concerns with hypersupply, oversupply in a lot of markets as well. You have a lot of supply coming online, which is having a downward push on rents, or rents are getting pushed down, and you're having also concerns when it comes to vacancy. So multifamily is going through somewhat of a difficult cycle currently, but there's also a lot of opportunities there if you can get in and buy some of these properties at 30% less than what they were transacted at just a few years ago, and the fundamentals are still there. there long term, it makes a lot of sense. But it's hard to make deals work these days, frankly.
Yeah, well, in the deal flow, in my part of what I do is invest in businesses through partnerships and similar arrangement to what you're describing, and finding the right fit that's going to stand the test of time is a challenge, and it sounds like that's what you're seeing as well. How significant is 1031 exchange money impact what you're trying to buy? And I'll preface that a little bit with a lot of what I see is the 1031 exchange money, that when people are willing to buy something that may not make any financial sense for you or I, they're still willing to do it. And that creates a competitive environment in a lot of sectors that just doesn't work to find deal flow. Is that what you see as well in the properties you're looking for?
Yeah, in the last 6 years, I mean, when it comes to competing with 1031 exchange deals, there's been one recent deal that we were involved with. It was a stabilized build-to-rent deal that we were purchasing, and we felt we gave a pretty aggressive offer, but we lost out to an exchange buyer who came in and just blew us out of the water. So I don't see it as a very common concern. I think overall 1031 exchange is great for the economy overall. There's no such thing in Canada, for example. I think that's a great way to force people to reinvest their money, and it stimulates the economy. So I'm a believer of 1031 exchange. As a investor, as a sponsor, do I see it as a common concern, us losing out to exchange buyers? Not really, but it has happened to us in the past. But that's just part of the business.
Yeah. Well, that's great. Well, I appreciate you sharing with us, especially with such detail, what you do and how you do it. It's a fascinating world, and especially when you're trying to do it the way your company does effectively at scale. Right? It's one thing to take down a building or two here and there. It's another thing to do it at a level that you participate. So I appreciate you providing so much detail. One of the things I always close up as we wrap up here, I like to talk with my guests. The people that are on my show have been successful in some way or another, and they generally didn't get there on their own. As a matter of fact, I've never met anybody who did. And so would you take a minute and just share a story about somebody that gave you a hand up towards you being as successful as you are today, or saw something in you when you didn't see it in yourself and believed in you that helped you get to where you are today?
Absolutely. It has to be my mother. I'm not sure if she believes in me. She still beats me down every day, but it was definitely her. And like I said, I come from somewhat a real estate family. My mother's father was in real estate. He owned his own brokerage, and I learned lots about real estate. I mean, one of the things she always told me that in real estate, if the business plan doesn't work out, at least you can move into it, right? It's
right.
Tangible, it's there, right? Lots of other things. I mean, I learned about real estate cycles at in an early age. I learned about inflation early on. I'm from Iran originally, and we had the revolution in 1979, and in late 70s, a lot of Iranians, wealthy monarchist Iranians, and a lot of Jewish Iranians started leaving Iran for the U.S. And those stories were told to me. Now, I was born in 81, but those stories were told to me by my mom and grandfather about what happened with lots of wealthy Jewish Iranians, how they left and sold their properties for pennies on the dollar, and just mass exodus out of Iran. And then when the Islamists took over Iran, interestingly, there was a lot of restrictions when it came to civil liberties, but when it came to economic liberties, it was actually pretty mostly open. People still could do business and what have you in real estate. So the flight to safety in Iran was because of hyperinflation, was always real estate. So I inherently understood that from a young age when it came to real estate being a safe asset and a great investment. And so on. So but long way of answering the question. Definitely, my mother has been pivotal in my life and career when it comes to real estate or otherwise.
Oh, that's great. Well, and honestly, I think that's how it is supposed to be, right? That our parents guide us and encourage us when we need it most. So yeah. So if people want to learn more about CPI Capital, how do they find you?
CPIcapital.com, our website. Reach us there. We have lots of great information on there. I'm personally very active on LinkedIn. August Biniaz. I believe I'm the only August Biniaz on LinkedIn. I'm very active there. So, in LinkedIn, you get noticed a lot because not a lot of LinkedIn users post regularly, but I'm one of the ones that does post regularly. So tell me you see me on the show, send me a message. Love to book a call and add value.
That sounds great. Well, thank you again for joining us. We really appreciate you being on the show.
My pleasure.
Well, I hope you've enjoyed this episode, a real deep dive into the world of private equity related to real estate. And there'll be more to come. We look forward to seeing you on the next episode. And that's a wrap on today's episode. We hope you enjoyed the conversation and got some valuable insights into the world of buying and selling businesses. Want to be a guest on our show? If you have a deal that you'd like to discuss with us or a business story to share, we'd love to hear from you. Shoot us an email using the contact information below in the episode notes, and let's make this happen. Never miss an episode. Make sure you subscribe on Apple Podcasts, Spotify, or wherever you listen. And if you found today's episode helpful, please leave us a review. It helps more people like you find the show.